Hi, welcome back to FANG Friday. This is Ross Healy. I'm the chairman of Strategic Analysis Corporation, and I'm a portfolio manager at McDonald and Associates Asset Management. What we've got here is our landing page at Strategic Analysis Corporation, and this is where we cover, or this is where we show what we've been working on recently. You can see actually here that we have just turned out a review of all of the Canadian oil stocks, just to see what looks good and what looks maybe still dangerous. And this, of course, was our most recent market commentary, coming soon, a fake recession. Anyway, let's get on with FANG Friday. We'll start off with Amazon, and Amazon just continues to drift lower and lower beneath its HB3 price. You recall last week that they missed their earnings, and the stock actually took quite a spill for Amazon. As far as we're concerned, the stock continues to head lower, and we're looking at some point here for the company to reach as low as the HB2 price, which is 12 times book value, or about $1,500. Very much the same thing with Facebook. Facebook broke down, actually pulled right back, as you can see here, to the mid-super growth price. That's 5.5 times book value, but subsequent to that time has been setting back, and really, even in this market strength, hasn't not been able to exhibit much upside here. Alphabet, well, I continue to show the long-term trend of Alphabet because it's in a trading channel. When we started the FANG Friday a few weeks ago, it was right up at the top of the channel, and although it got pretty close to the bottom, it didn't quite make it, and we're still hoping that we're going to get a good buying opportunity down at the super growth price, and that's a very, very powerful support level. Netflix, a little more problematic. We have not liked Netflix, of course, right from the beginning. Here's the beginning of April when we started FANG Friday, and the stock has been drifting lower and lower ever since. Most recently, however, it's been hanging right around its HB3 price. That's about 16 times its book value. Perhaps anticipating better than expected earnings this quarter. Look what happened the last quarter there. It disappointed, and the stock not only cratered, but it actually dropped through the HB4 price. So we're going to see. NVIDIA, well, NVIDIA continues to in effect kind of really surprise us. When we started out, we didn't like this company at all. It had a huge fall from grace, but it had a dead hit on its bubble price at 7.4 times book value, and had a beautiful rally, and had set actually back almost to the bubble price once again. It moved up to the HB1, that's 10 times book, a little bit over that, a little bit back, a little bit over, a little bit back. Bitcoin has been strong, so just as of late, and so has NVIDIA with it. Maybe we'll be wrong that we didn't buy this stock and ride it up to its HB2 price. That's 12 times its book value, but we have yet to see that the company can actually make it there or not. Microsoft, which we've been kind of throwing in, I wouldn't say gratuitously, but because it kind of fits in with the FANGs being an enormous market cap. Look at that, still over $1 billion, $1 trillion. So we've been kind of throwing it in there as being kind of part of that leadership group that has been doing very well since 2008, but is so high now that it's fundamentally running out of value, and the stock has not been able to get through the HB1 price. I've showed you how extremely powerful as a resistance level that has been, actually, for going back for decades. Apple, well, Apple continues to surprise us somewhat. It has typically, over the past 10 years, it has typically peaked out just about its fair market value. That's the dotted line going back there. It got a little bit above there a little while ago, had a big setback, but has since rebounded back up there again. And the stock appears to show no signs of peaking out. And I wonder if these share buybacks have got something to do with that. And what I'm going to do is reference Apple with regards to another company that indulged in share buybacks and had some quite stellar fireworks because of that. And that, of course, is our friend McDonald's. And here's the long-term chart of McDonald's, in which I showed you that essentially this is 35 years, essentially going back all that period of time, the stock tended to peak out at about its fair market value. And that's very usual for companies that have large capitalizations and have been around for a long period of time. The only previous time that it didn't do that was back in the market extreme of 2000, and then it had an enormous setback. First of all, it was 50%, actually it was 100% above its fair market value, fell back to the fair market value, hung there for a while, and then went to a discount to it. Well, since that time, the stock has been doing quite well, and of course, to really appreciate why it's been doing that, what I've done here is I've simply referenced the fair market value to its price to book. In other words, what I've done is I've got an ROE chart. And of course, with the disappearance of the book value, the ROE, of course, has gone absolutely ballistic. However, of course, in a structural valuation analysis, there is no such thing as negative book value, because we always have a measure for what we call the value of entrepreneurship. And the value of entrepreneurship in the case of McDonald's is $2.03. So that actually we can then use the earnings and get a fair market value. Well, that fair market value is $91, and the overvaluation therefore is 50% once again. So the company is getting into very high value indeed. Now, what's really intriguing about this chart here with reference to Apple is, do you suppose that Apple might do something similar? In other words, they might buy back a lot of stock. They've already announced a $40 billion buyback, but are they going to buy back and buy back and buy back and produce something that looks like this? In other words, the ROE keeps on rising and the stock price goes with it. Well, as we see with McDonald's, trees don't grow to the sky. They may be well past their fair market value, but on the other hand, they're not so far past it that they don't run out of gas. And here is what's been happening with McDonald's recently. It's kind of rolling over. And indeed, if I show you what I might call a standard technical view of the company, it's actually rolled over quite a bit. Now, it's got back down again to the point where it may rebound here again. So we're not saying this is going to continue on. However, we are saying that the stock is very poor value. But I particularly wanted to do a reprise of McDonald's just to show you the potential that perhaps Apple might be looking at. Anyway, this has been FANG Friday for this week. I hope that you've enjoyed it. I'm Ross Healy, the chairman of Strategic Analysis Corporation and a portfolio manager for McNichol and Associates, reminding you that nothing, including investing, is difficult if you have the right tools. I'll see you next week.